Trading in the Shadow of the Smart Money, Gavin Holmes. The Game and the Players. Welcome. What you are about to hear is a window into one of the most powerful and least understood forces in financial markets, the smart money. And once you see it, you can never unsee it. Have you ever bought a stock or a crypto asset, felt confident, and then suddenly, without any clear reason, the price collapsed right after you got in? You looked at the news. Nothing unusual. You checked your analysis. It seemed fine. So what happened? What happened is that someone, some institution, understood the game at a level you were not playing at. That someone is what Gavin Holmes calls the smart money. This book teaches you how to read the fingerprints the smart money leaves on every single price bar, every single day. You will learn to look at a chart not as a random squiggle of prices, but as a story of who is buying, who is selling, who is accumulating quietly, and who is dumping at the top. The methodology at the heart of this book is called Volume Spread Analysis, or VSA. It was developed by the legendary trader Richard Wyckoff in the early 1900s, refined by Tom Williams decades later, and brought to modern traders by Gavin Holmes. So who is the smart money? They are the professional operators of the market. The large banks, hedge funds, market makers, and pension funds. Entities that move billions of dollars every single day. They have one enormous problem you and I do not have. They cannot simply click a button and buy a million shares at once. If they tried, they would move the market against themselves. Prices would spike the moment the market sensed their large order, and they would end up buying at terrible prices. So instead, they accumulate positions gradually, over weeks or months, disguising their buying as normal market activity. And this is where VSA comes in. Because no matter how carefully they try to hide, their activity leaves traces in the data available to every trader, price and volume. The core premise of VSA is this. Volume tells you the activity of the market. Spread, the range between the high and low of a bar, tells you the result of that activity. Learn to read these two elements together, and you can detect whether smart money is buying, selling, or simply waiting. Reading price bars and the four market phases. On every single bar, VSA looks at three things. First, the spread. How wide is the bar? A wide spread means the price moved dramatically. A narrow spread means it barely moved. The spread tells you the result of the battle between buyers and sellers. Second, the volume. How much trading took place? High volume means enormous activity. Low volume means little interest. Volume tells you the effort behind the move. Third, the close. Where did the price end the bar, near the top, the middle, or the bottom? A close near the high tells you buyers were in control. A close near the low tells you sellers won. VSA traders use one phrase constantly, effort versus result. Does the effort, the volume, match the result, the spread and close? When effort and result do not match, the smart money is at work. That mismatch is your signal. Now let us talk about the four phases every market moves through. Phase 1 is accumulation. The market looks boring. The news is usually bad. Retail traders have mostly given up. Prices move sideways. But beneath the surface, a massive transfer of stock is happening, from weak, scared retail investors into strong, well-capitalized institutions. The smart money is accumulating. Building positions at low prices. And doing it so carefully that most traders miss it entirely. Phase 2 is the markup. Once the smart money has accumulated enough shares, they begin pushing prices higher. This is the bull market phase. Prices rise steadily with strong volume on up bars and weak volume on pullbacks. Many retail traders only recognize this phase after it is already well underway, and they buy near the top, right as the smart money is preparing for what comes next. Phase 3 is distribution. Here is where the trap is set. After pushing prices higher, the smart money needs to sell their positions. So they distribute, gradually selling to the enthusiastic retail public who are now convinced prices will go even higher. Distribution looks deceptively similar to accumulation. Prices move sideways. Volume is high, but now institutions are selling to excited retail traders, not buying from scared ones. The market looks stable, even bullish. But underneath, the foundation is crumbling. Phase 4 is the markdown. Once distribution is complete, prices collapse. Retail traders who bought during distribution panic and sell at massive losses. And then the cycle begins again, accumulation starts at new lower prices. This cycle has repeated throughout financial history, in every market, on every time frame. The Wyckoff cycle is timeless. Signs of strength, where smart money buys. Now we get to the practical heart of VSA, the specific signals the smart money leaves when it is buying. These are called signs of strength. The first is stopping volume. Imagine a market that has been falling for days. Fear is everywhere. Then one day you see a bar with extremely high volume, a wide spread downward, but the price closes in the middle or near the top of the bar. The volume is massive, but the price did not close at the lows. This is stopping volume. The smart money stepped in and absorbed all the selling. The high volume tells you enormous activity took place. The close off the lows tells you buyers successfully absorbed every share panicking traders threw at the market. This is one of the first signs a bottom may be near. The second sign of strength is no supply. After a rally, you sometimes see a small pullback with a narrow spread and very low volume. The price dips slightly, but there are almost no sellers. If the market were genuinely weak, you would expect sellers to appear on any weakness. Instead, a low-volume narrow spread down bar tells you supply has dried up, there are no sellers left. And a market with no supply can only go one direction, up. The third sign of strength is the test. Smart money professionals test the market after accumulating. They push prices down slightly to confirm supply has been removed. If volume during this test is low and prices recover quickly, it confirms the coast is clear. A successful test is one of the highest probability buying signals in all of VSA. The fourth and most elegant sign of strength is called the spring. Near the bottom of an accumulation range, the price suddenly breaks below key support. Retail stop losses trigger automatically. Weak holders panic and sell. But instead of continuing lower, the price snaps back quickly, closing well above the support level, often on lower volume than the prior selling. The break below support was a trap. It was engineered to shake out weak hands and gather more stock at low prices before the real move higher begins. The spring is a classic smart money maneuver. When you see a spring followed by a low-volume test, you are looking at one of the clearest signals that accumulation is complete and the markup phase is about to begin. Signs of weakness, where smart money sells. Just as important as knowing when smart money buys is knowing when they are selling at the top. These are called signs of weakness. The first major sign of weakness is the upthrust. This is the mirror image of the spring and one of the most powerful bearish signals in VSA. After an extended rally, the price breaks above a key resistance level. Buyers rush in, convinced the market is heading to new highs. But the breakout is false. The price closes back below the resistance level, sometimes near the very low of the bar. Volume is typically high. The smart money used the excitement of the breakout to unload their positions onto eager buyers who thought they were catching a genuine move higher. Instead, they were buying at the top of a distribution phase. The second sign of weakness is no demand. During an uptrend, you see a narrow spread-up bar with very low volume. The price moves slightly higher, but nobody is participating. Without new buyers, prices cannot sustain higher levels. No demand bars often precede reversals. The third sign of weakness is the effort versus result mismatch on the upside. Imagine a day with extremely high volume, massive effort, but the price only moves up slightly, or closes in the middle of the bar. The effort is enormous, but the result is disappointing. This tells you that despite all the buying activity, sellers are matching every bid. Supply is overwhelming demand. The smart money is distributing, selling into the enthusiasm. In a healthy bull market, high volume should produce wide-up bars closing near the highs. When high volume fails to produce strong upward movement, the market is telling you the truth, even if the news says otherwise. Now a concept that ties everything together, the background. A single bar never tells the complete story. You must always ask what the context is. What has the market been doing over the past weeks or months? The same signal means completely different things in different contexts. A sign of strength after weeks of accumulation is a high probability buy signal. The same sign of strength after a long uptrend near resistance might be nothing more than a temporary bounce. Holmes also teaches the law of cause and effect. You cannot get an effect without first building a cause. A long accumulation phase creates a large cause. The markup phase creates a large effect. The longer the accumulation, the more powerful the uptrend. This law teaches patience. Wait for markets where significant cause has been built. A full trade from start to finish, and the psychology. Now let us walk through a complete trade from start to finish using VSA. First, you identify a market that has been in a downtrend and appears to be stabilizing. Prices have been falling, but now they are moving sideways. This suggests the possibility of accumulation. Second, you look for stopping volume, high volume bars where the price does not fall further. Several such bars within a sideways range strengthen the accumulation case. Third, you watch for tests and springs. The smart money pushes prices down slightly to test whether supply has been removed. If these tests happen on low volume and prices recover quickly, the background is becoming increasingly bullish. Fourth, you wait for the sign of strength, a widespread, high volume up bar that breaks out of the sideways range and closes near the highs. This confirms smart money is beginning to mark up prices. Fifth, you watch for a brief pullback after this sign of strength, what Wyckoff called the last point of support. This pullback, on low volume with narrow spread, is your entry point. The market is confirming demand is still intact. You enter the trade. Your stop goes below the last significant low. Your target is estimated using the size of the accumulation range, the cause, projected forward as the effect. Now let us talk about psychology, because this is where most traders fail before they ever make a mistake on a chart. The smart money succeeds not just because of their capital, but because of their emotional detachment. They do not panic when prices fall. They do not get excited when prices rise. They follow a plan and execute systematically, and they understand that the emotions of the crowd are their greatest ally. Retail traders, by contrast, are driven by fear and greed. They buy at tops because the news is exciting. They sell at bottoms because the fear is overwhelming. And every time they do this, they are on the other side of the smart money's trades. Literally. The retail trader selling in panic is selling to the smart money who is accumulating. The retail trader buying in excitement is buying from the smart money who is distributing. Learning VSA is not just about chart patterns. It is about developing the discipline to be contrarian, to be interested when others are fearful, and cautious when others are excited. To see a large red candle on enormous volume not as a signal to panic, but as a potential sign that professional buyers are stepping in. You must stop asking whether the news is good or bad. You must start asking, what is the volume telling me? What is the spread telling me? What are the professionals doing right now? Common mistakes and the final conclusion. Gavin Holmes identifies 4 common mistakes new VSA traders make. The first mistake is ignoring the background. New traders see a sign of strength and immediately buy, without asking whether the background supports an uptrend. A sign of strength in a weak background is not a buy signal, it is a warning. The second mistake is trying to trade every signal. VSA offers many potential signals on any chart. But not all signals are equal. Holmes urges selectivity, waiting for the clearest, highest probability setups in the strongest backgrounds. Fewer trades, better quality. The third mistake is using VSA in isolation. Holmes recommends combining VSA with traditional technical analysis, support and resistance levels, trend lines, and moving averages. VSA tells you who is doing what and why. Traditional technical analysis tells you where the key levels are. Together, they are powerful. The fourth mistake is expecting certainty. VSA does not predict the future with certainty. No method does. What it does is shift the probabilities in your favor. You will have losing trades. The goal is small losses and large wins. VSA, by identifying high probability setups in clear context, helps you achieve exactly that over time. One final point, VSA works on every market and every time frame. Stocks, futures, forex, commodities, cryptocurrencies, any market with genuine price and volume data. The language of VSA is universal. Now, the conclusion. Markets are not random. They are driven by the deliberate actions of professional operators, the smart money, who accumulate at lows, mark up prices, distribute at highs, and mark down prices. This cycle repeats endlessly across all of history. Volume spread analysis gives you the tools to read this cycle. Signs of strength, stopping volume, no supply, tests, and springs, reveal accumulation. Signs of weakness, upthrusts, no demand, and effort without result, reveal distribution. The background provides the context. And the law of cause and effect reminds you that the size of the coming move is proportional to the accumulation that preceded it. The most consistent way to succeed in markets is to understand the game that is being played, and to align yourself with the most powerful players rather than fighting them. Gavin Holmes, building on the timeless foundations of Richard Wyckoff and Tom Williams, has given traders of all levels a practical, logical, and powerful framework for doing exactly that. The smart money is always active. They are trading right now, in every market around the world. The only question is, now that you understand their methods, will you trade in their shadow, or continue to trade against them? Thank you for listening. This has been a summary of Trading in the Shadow of the Smart Money by Gavin Holmes.